In today's video, I want to go over some non-technology related stocks that you should consider buying in 2018. Let's go. Welcome back guys to another video. My name is Nick, and on this channel we cover finance with a sprinkle of technology. If you like these kind of videos and want to see more like this, make sure to hit that subscribe button down below to support the channel, drop a like on this video to support me, and let's get on with it. Alright, so I know that there's tons of companies out there, and you might not agree with the picks that I go over today, but what I want to do is kind of open your mind up to companies that you might have not considered, especially to those of you that are heavily invested in tech companies like myself. So all I really have to say is keep an open mind, hear what I have to say, leave a comment down below on what you think about these companies and other companies that you feel that I should consider or other people should consider going into 2018 that are non-tech related. Alright, so let's get right into it, and the first stock that we're going to look at is Johnson & Johnson. So these guys are a huge name in the medical and pharmaceutical sector in the industry. Everyone's heard of this company, especially those that have parents, that have kids, because there are tons of baby products out there that are also Johnson & Johnson. And I'm sure a lot of us out there have used Johnson & Johnson as a baby as we were growing up. So they've been around for a while, they're a solid company, and I want to dive in today into why I think this is a good stock to hold in 2018. So like I just mentioned, their real focus and the real consumer focus, I would say, is that they heavily invest in baby products and baby necessities like shampoo, soap, all that kind of stuff. And a lot of people who have babies, you'll notice that a lot of their products are Johnson & Johnson branded products. So they have a huge presence in this space, and they pretty much have cornered this market and have been the dominant player for the longest time in this market. But if you take a look outside the business, it's not necessarily the most exciting stock or exciting company, but one thing that I do like about Johnson & Johnson is that they're stable, they've proven themselves, and they have a lot of growth ahead of them as the world continues to evolve, and we still rely on these basic products like baby products. So if we jump over to the charts for Johnson & Johnson, you can see here that they pay out a dividend of about 2.36%, and if you look at their chart over 2017 year to date, they've grown about 23% this year. Now this is huge growth considering how massive this company is, and we might see a similar growth in 2018, but don't bank on that because this is an unexpected growth year for this stock and for most stocks in general in the stock market. So we'll be happy to see double-digit growth next year, but don't expect something as high as 23%. But now when you compare it with the Dow this year, you can see that it was pretty much in line with the Dow. I mean, we had similar growth with the Dow as compared to Johnson & Johnson. But if we take a look now, diving deeper into the technicals, you can see that the stock currently, as of recording this video, has good upward trend support, and it's tested it a couple times and held it twice so far. My entry point personally when looking into this stock would be when it comes down to test this level again, so that would be around the $137 or so target. Another confirmation why I would like this level is because when it comes down here, it would also test the 100-day moving average, which is a really good indicator that a stock is coming down, test key support levels, and if it can hold that, we'll see a move much higher to the upside. So finally now, if we take a look at the balance sheet, you can see that their overall assets have increased for this year by around $8 billion. However, their debt has also increased by around $8.5 billion. So this is typical for larger companies, and it's usually due to acquisitions that they're making, and this is the case for Johnson & Johnson as well. However, even looking through the balance sheet, I do believe overall that Johnson & Johnson is still a healthy company as they are positive $20.7 billion or so after all the debt is accounted for. Alright guys, so now that we looked at the health space and a good company to hold in that space, let's take a look at a company in a completely different sector, and that's a company that's been around for a while. A lot of us have grown up watching their content, and that is Disney. So a lot of big news has come out of Disney in this past year, and one of the biggest is that they have announced that they're going to start their own streaming service in 2019, and in turn they're going to be pulling all of their content from Netflix. This means starting in 2019 and onwards, you're not going to see any Disney content on Netflix, as Disney's going to offer their own services now for you to watch this on. So another big announcement that they came out with this year is that they're going to be acquiring Fox content. So this includes content like Marvel, which is a massive series that has generated billions of dollars over the years, and now Disney owns all the rights to this and all these characters. And also with this acquisition, they also take over Hulu, which is a streaming service available in the United States where you can watch your favorite TV shows. And my guess, even though this is not official, is that they're going to be integrating their new streaming service that they announced in 2019, that they're going to probably take those two ideas, Hulu and the streaming service, merge it into one, and have that offered as their new Disney platform in 2019. So their content does not end there, because they also own ESPN and now Fox Sports as well. So they pretty much cornered the market in this area as well, because now they're one of the most dominant players when it comes to sports and sporting events, which are huge in North America. The last bit of information that I found interesting for Disney, especially going into 2018, is that their amusement parks are still thriving. And not only that, but they have announced in 2018 they will be raising prices for some of these amusement parks, which means that their revenues and profits will increase substantially going into 2018 and 2019. Okay, so now if we shift gears and take a look at the stock, you can see that they pay around a 1.51% dividend as of recording this video. But if you look at the stock year to date as of recording this video, you can see that it's been beaten down really bad in 2017. But with all the bad news and all these rumors and all this kind of negative press around Disney over the past year, I feel that that's kind of behind the stock now, and that going into 2018 will actually be a positive year for Disney, especially now that they have announced that they will be acquiring Fox, and I think we'll see a solid year for them in 2018. So we take a look at how much Disney was up in 2017. You can see here that it was up only 6% or so on the year. But again, they do pay a dividend and they are a good hold. So even though they didn't perform as well as most were expecting, they still had an okay year. But like I said, I think 2018 will be the year that they really explode and really have double-digit gains and growth. Now, if we look at the technicals, you can see that it had a choppy year like we just talked about, but it's holding its uptrend support at around $100. But it has some strong resistance at around $113 or so. And if we can break past this resistance, we can see this run, I think, to around $120 or higher in 2018. It's not a huge run from where the stock price is right now, but it should be better than the performance we had in 2017 if this holds true. So let's cross our fingers for that, and let's hope that there is no negative news that comes out of Disney in 2018. So now finally, let's take a look at the balance sheet of Disney. And here you can see that their overall assets for this year have increased by around $3.8 billion. However, their debt also increased more than their assets by around $4.6 billion. Now, the Fox deal isn't included in this current balance sheet and will be reflected in their next earnings report. So that's something to keep in mind for the next earnings report, as numbers would be a little more skewed when that comes out. Overall, though, it's still a healthy company, and they have positive $2.8 billion after all the debt is accounted for, and the acquisition in Fox and all of that kind of stuff should push this to double digits in a few years, in my opinion. Like I mentioned earlier, I think the biggest threat to Disney right now, especially when it comes to content, is Netflix, because Netflix really is seen as the content king these days. They release a lot of great content, they have a lot of great subscribers, and they are expanding globally. But this won't really be too much of a concern in 2018. I would think more 2019 is when I would start considering maybe lowering my stake in Disney, because I'm not sure how their streaming service will compare to Netflix, how the competition will be, and all that kind of stuff. But going into 2018, Disney is my number 2 pick. Alright, so now that we've gone through the first two in two completely different sectors, let's end things off with the third and final pick, which is a company that I would never have thought that I personally would ever consider investing in. But after looking into their numbers and the changes that they have done in 2017, it's definitely one that I'm considering as one you should look at as well. And this company is Walmart. Walmart is really focusing on e-commerce, especially going into 2018. And you can see this past year that their growth in e-commerce has gone up over 50% in the United States alone. Now this is in turn with their acquisition with Jet.com, which to be honest, I had never heard of before, but it is a fairly large e-commerce platform, and Walmart plans to leverage that going into 2018. What they'll be able to do with this new Jet.com platform is they're going to be able to offer same-day delivery to compete head-to-head with Amazon. So of course, Amazon is Walmart's biggest threat and biggest rival, especially going into 2018, 2019 and onwards. And in my opinion, I think that Walmart is one of the only companies that can seriously compete with Amazon, especially on the price standpoint. Walmart will also be putting a huge focus on groceries going into 2018 because they have announced that they are going to be opening up around 1,000 grocery pickup locations in 2018. So this will make things easier for consumers to go and pick up their groceries from a local Walmart station. Now, if we look at the charts of Walmart, you can see here that they have around a 2.1% dividend, which is a pretty solid dividend in my opinion. And if you look at their growth in 2017, they've had an amazing year with over 40% growth. Now, looking at their technicals, you can see that the stock has gapped up a few times this year, and most recently was after their latest earnings report. However, it's still in a healthy uptrend, so there's nothing really that I'm too worried about here. There is uptrend support at around $80 or so, and it has tested this a few times this year, including when it did sell off after the whole Amazon and Whole Foods deal announcement earlier this year. But currently, I think we're consolidating and we're waiting for some news to move the stock higher and past that $100 psychological threshold. So I think that we will most likely break the $100 in a few weeks, if not by the end of this year if things go well. But we may come down to fill the gap that it did create at its previous earnings report. So we might go down lower and then start to move higher and break the $100. Now finally, if we take a look at Walmart's balance sheet, you can see here that their overall assets have decreased this year by around $750 million. And their debt has also increased by $2 billion. I think that this is most likely because they're investing heavily in online shopping and they are putting money into that. It would make sense to me that their debt is increasing because they are kind of in a transformation stage right now. Overall, though, I still think it's a healthy company as they're a positive $60.1 billion after all the debt and liabilities are accounted for. So the real threat and the real elephant in the room is Amazon. And I believe that Amazon is, of course, the biggest threat to Walmart, but Amazon right now is kind of the only player out there that offers good online shopping and a good online shopping experience for almost anything that you want. I think that Walmart has the products available, but they just need to improve their online catalog, online system, ordering process, all that kind of stuff. And we can see that they are investing in this, especially with the acquisition of Jet.com. So I think 2018 will be a great year for Walmart. I think that there's tons of room for both of these companies to grow, especially in 2018. And I think it's about time that Amazon really gets a true competitor in this space. And Walmart is the company that I'm betting on that will be able to give Amazon a good run for its money. Okay, so that pretty much sums up the non-technology related picks that I think that you should consider buying or even taking a look at in 2018. Now, all of these things, all of these picks, all of these companies that I went over today are just my opinion. I'm not a financial advisor. You shouldn't look at my picks and just make your decision based on that. You should always go out there, make your own informed decisions, do your own research, and then invest in stocks that you think will succeed, especially in 2018. So if you enjoyed this video and you like this new recording style that I'm doing, make sure to leave a comment down below and let me know what you like about it, what you don't like about it, what I can improve on it. Leave a like on this video, subscribe down below if you haven't joined the community already, but either way, I'll see you in the next one. Peace.